Hello, everyone, and welcome to our weekly show, the Dividend Power Hour. It's great to be with you. If this is your first time joining, my name is Mark Rusin. I'm a CPA here in the state of California, and this is our weekly show where we discuss happenings going on in the market from a week-to-week basis. Look at some economical reports that's going on, maybe some educational type stuff that we'll touch on. You never know what we're going to touch on here in the Dividend Power Hour, and that's what makes it so great. We always have an interactive group, so this is meant to be interactive. So if you have questions, feel free to throw those down in the comment section. I'll try to get to as many questions as I can, but there's also a lot of very smart individuals that join this weekly show each and every week that probably could be able to answer it as well. So again, it's good to be with you. Let me know who's out there tuning in. Let me know where you're tuning in from and what were some stocks that you bought this week so far. This is our Tuesday edition. So normally our shows are on Wednesday, but we have a special free investing webinar tomorrow. So hopefully you'll be able to join me tomorrow for that. And I'll tell you some more information about that here in the coming minutes here. So what do we got? Birds and the bees. Haven't seen you for a while. Good to see you. What's a good long-term play for beating the S&P 500? I'm leaning money market account. Not sure about that there. Money market's been, less than 5%. I mean, high yield savings accounts right around 5% right now. And the S&P 500 has been blowing that out of the water right now. Bitcoin, not really going to have much of a comment on cryptocurrencies. Not my expertise there, my cup of tea. Sean Wong, good to see you, my friend. Bought some fractional shares of Amazon and Google, two stocks I absolutely love right now. Amazon, I am trying to build up to be one of my, it already is one of my top holdings there, but looking to get it up there with the likes of Alphabet, which is already my top holding. Robert, hi, Mark. No bad actors, hoping to stay the entire hour. Love it. Great to have you, Robert. Thanks for tuning in. Jeremy from Toledo. What else we got here? What platforms do you recommend to onboard info or into for the market of stocks in the U.S.? I haven't invested in a long time, but been following you for over a year now when I can. I appreciate you. SoCal, awesome. So in terms of onboarding, I mean, if you're asking in terms of brokerages, I've used Vanguard, I have Fidelity, I've used Schwab as well in the past, but so I kind of try to spread it out as much as I can. If you're looking for some more smaller, more mobile, I've used the likes of Moomoo, Webull, and M1 Finance as well. So Scott T tuning in from New York. Shiva's tuning in from Texas. Good to have you. Kevin just jumps in. Love it. Carl Little, good to see you, my friend from Tennessee. Bought some SPLG. What do we got here? What's up, Mark? Ty from Seattle. It is hot out here, and it is hot here as well. I'll be in Arizona in the coming weekends. And this past weekend, it was about 122 degrees there. So that was some serious heat. I was glad I wasn't there that particular weekend. Mike from Charlotte bought some fractional shares of VGT. King David, one must consider the tax status of treasuries, munis, and CDs when investing. Got to consider the tax when investing in any type of investment there. Hi, Mark. Bought some ARE from Long. Awesome. Thanks. Yeah, I'd like Webull and M1. Yep, I've used both of those in the past. Don't use them a ton right now, but tuning in from North Carolina, and my friend Jeffrey Hatch from Washington grabbed some Vici and some Pfizer, dipping in some low-end, low-priced, cheaper stocks right there. Pfizer, I've been trying to build a small position in there. I like it under $30 right now, and you guys already know that I love me some Vici there. Brazil is in the house. Bought some Intel, Nike, Vici, PepsiCo these days. Like your work and tips. Thank you. I appreciate that. Thank you all for tuning in. Robert said, my buys are in the Discord. People should really consider joining your Discord. I appreciate that, Robert. And there's a link down below for those of you that aren't part of our Discord community. That is the easiest and fastest way to get a hold of both me and my team there. And you become a Edge Plus member. See all of my stocks, all of my buys, get sell alerts, any option type plays that I'm doing there as well. So let's kick this Tuesday edition of the Dividend Power Hour off by jumping into our regular slide here. If this is your first time joining, this is our economic update slide where we go through this each and every week and we see where are the markets at, what are some key topics we'll be discussing today. Take a look at valuation as well as interest rates. So right now, markets have been kind of trading sideways, albeit slowly but surely climbing up. Some of the major mega cap tech stocks have climbed higher there. And we'll touch on Tesla, what kind of week or past few weeks they've been having. But let's first take a look at the markets here, where we see the Dow Jones is up 4.3% year to date, slightly down from the previous time we've met. S&P 500 up nearly 17%. NASDAQ's up at 23%, and the Russell still just kind of staggering right along there. So small caps have been doing absolutely nothing there. In terms of valuation, analysts still looking for 2025 EPS of $279, which equates to a forward S&P 500 PE of 20 times there. Just to give you an idea, the S&P 500 typically trades right around 17 and a half times. So we are definitely elevated right here, and earnings expectations are high. Now we're coming into earnings season. The big question is going to be, can these companies live up to those expectations? Because if they can't, that could start what a lot of investors have been waiting for, is a little bit of a pullback here. So let's take a look at interest rates, where we see the 10 years at 4.3, the 2-year at 4.6. So a nice little dip there on the 2-year, slight dip on the 10-year. Both rates are falling there in place as it is right now. So now what? Well, if you were paying attention or were able to stay up with the markets at all today, we had Fed Jerome Powell that was going through his regular time with Congress, and we're starting to get some indications that rate cuts are on the way, folks. We've kind of talked about this a bunch in our Dividend Power Hour about, is it going to be one rate cut? Is it going to be 2 rate cuts? Or is it going to be 0? A lot of you have switched over to the 0 camp, and I've kind of stood there and said, hey, I think we're still going to have 1, maybe even 2 rate cuts, which is still what I believe to this point in time right here. But the last time we met, if we fast forward back to last Wednesday, I think a lot of folks came back to the camp that, hey, I think now, based on the data we're seeing, based on the commentary we're hearing from the Fed, it seems like 1 interest rate cut is in the cards right now. So that's kind of the plan of where I believe rate cuts are going to be. But it's going to be interesting. What we're going to talk about is interest rate cuts happen for a number of reasons. They can happen for 2 primary reasons here with this upcoming cut. The Federal Reserve can kind of claim victory if we do get inflation under control, which, as you can see there, CPI report is due out this week. So that's going to be our latest indication of, do we have inflation under control? If we get something that meets expectations or comes in even lighter, that's going to be a great sign from that aspect there. That means we're getting inflation under control. It was at a high of over 9%. It's still sitting in about that 3.5% when we're talking about core CPI. We need to get that under control first and foremost. The other reason that the Fed usually cuts rates could be the fact that the economy is slowing. The job market is getting worse from that standpoint. So they're trying to do a balancing act of not keeping rates too high for too long, but also trying to get inflation under control, which is why they're not going to move too early. And there shouldn't be any move expected here for the July meeting. That happens in roughly 15, 20 days from that standpoint. So mega cap, though, that continues to be the place to be. If you're looking for somewhere to invest right now, it has been mega cap. That is, you need to continue to focus on quality. As we saw at the start or at the top up there, you can see small caps have done nothing. The Russell 2000 has gone absolutely nowhere for the entire year. Meanwhile, the S&P 500 is up roughly 17%. Much of that has to do with the likes of NVIDIA and all of these mega cap tech companies, including the likes of Amazon and Tesla starting to, rev again. So I guess electric cars don't really rev. I don't know how that works, but that's neither here nor there. So mega cap tech. And then, as I mentioned, CPI report due out. Here's our weekly look at the fear and greed index. And you can see pretty much telling us nothing. It's right down the middle in neutral. Investors aren't too fearful, and investors right now aren't too greedy. So there's a lot of, concern around the market. We don't know which way the market's going to go right now. We are all kind of on pins and needles right now, waiting for that CPI report to get a better indication of where interest rates are going to be headed. So let's head over here to the iPads. Let me get that set up for you guys right now. Do you guys own any small caps? I saw some questions there, but Anne has a question. Do you think small caps will eventually move up? And I think they will eventually move up. They usually tend to do well. They can be a little bit more cyclical, but they can perform well when the economy is doing well. We've started to see some cracks in the economy, though. However, We've seen jobless claims up. We've seen the JOLTS report come down from that aspect of things. We've seen reports from companies, not just economic data, but we've seen actual reports, earnings reports from companies talking about a weakening consumer. And you have to remember, the consumer makes up 70% of the entire GDP for this particular country here, that being the US. So we got to have a good economy here for those small caps to get rolling there again. So JC rolled in here. Sophia tuning in from San Francisco. Awesome there. Shiva's got a question. What are your thoughts on Yield Max ETF? I went against buying last year, but if I had, I would have covered 80% of the cost already, and monthly dividends are free money from there. Why are they frowned upon? So these high yield ones, they can kind of limit your upside to a degree. So when you have these high, like think of the likes of JEPIs and the JEPQs, they're selling what's called a covered call. It's a derivative, an option play from that standpoint, which means they own the underlying stock, but they are agreeing to sell it at a particular price. So if they'd agree to sell it at a particular price and the stock price just climbs right through that, well, your upside is limited. You're not going to partake, JEPI and JEPQ aren't going to partake in any of the gains above that particular strike price because they already agreed to sell their underlying stock. So there is some upside. It's just capped from that standpoint. I do a lot of options myself. I've had hundreds of students that have come to me through the coaching program to do my 2-part option module where we go through things like covered calls and cash secured puts and credit spreads, debit spreads, ways to be more aggressive, but more realistic and conservative approach. I don't do any YOLO type trading from that standpoint. And we show all of our trades over on Cashflow University, which is our premier cash flow, or I should say option community that I started with a group of friends that I have over there. So if you haven't checked that out and you're strictly just interested in purely options, definitely check out Cashflow University over there. So just not a big fan of those high yield for my portfolio in general. From that standpoint there. So, all right, so let's take a look here at our sector breakdown. So let me share that screen with you right now. Here we go. So if we look here, you can see year to date, S&P 500 technology and communication services continue to be our best performing sectors. No change from the last time we met. But again, the only 2 sectors that continue to outperform the S&P 500. That right there tells you just how much weight these large companies, because those largest companies that are within the S&P 500 are in these 2 sectors. Apple, Microsoft, NVIDIA, Meta, Alphabet, all of them are in those sectors there. Then coming in third is going to be financials at 10%. They've had a nice little run there. And I have Bank of America and SCHW, Charles Schwab there are 2 big ones, as well as Visa. Consumer discretionary has got a nice little pop with the likes of Tesla and Amazon holding down that sector. Consumer staples, utilities, energy, and then at the very bottom down there, we can see our very own real estate continuing to be the only sad red sector that we have. So over the past 3 months, information technology just continues to run away with it, up 20%. No other sector is even in double digits from that standpoint right there. Communication services at 9.5%. And again, even over the past 3 months, these 2 sectors continue to be the only sectors that are outperforming the S&P 500, and they have the largest weighting there. How about the past month? Let's look at a little bit more recent type of data here. We could see technology and consumer discretionary. That's going to be a lot more the Teslas and the Amazon. That run that Tesla has had, which we'll have a slide here in a little bit, has been 10 straight days and counting. So it's not even over yet. So for those of you that are Tesla bulls, Tesla shareholders, you've probably enjoyed the past 10 days. We're still, though, 20 or 15 or so percent off of their 52-week high. So it's not like they're trading at all-time highs. They have just fell so far so fast, and they're just recovering those losses now. So that's kind of where we sit over the past month. You can see materials, utilities, healthcare, industrials, consumer staples, all thought of as defensive sectors, all in the red over the past 30 days from that standpoint there. So where do we move now? Let me tell you about a special free webinar. So if you're interested and you love things that are priced at free, you're going to love tomorrow's free market update webinar, where we're going to go through things like the first half. So we'll recap what happened in the first half, but more importantly, turn our attention to the back half. What are some concerns that I have about the market upcoming? What are some things that I really like? What are some sectors I like, especially going into the third quarter right here and things like that? And as always, we'll be going through my top 10 holdings that I currently have within my portfolio. So I hope to see you there. There's a link down in the description below to save your seat for tomorrow's webinar. That'll be starting at 8 p.m. Eastern time, which is 5 p.m. Pacific time for those of you that are on the West Coast with me there. So we'll be going through a whole game plan and so much more. I hope you'll be able to join us for that free investing webinar market update tomorrow. So excited for that. And I know a lot of you have already reached out and are already signed up there, as we have roughly 300 people signed up for that webinar so far. So let's go and take a look at a recent video that I put out. I like to frequently go through some of the videos that I put out, kind of get some commentary from you guys. After all, this is meant to be interactive, but we took a look in one of my recent videos. And if you haven't had a chance to watch it, make sure you go watch that video to get a little bit more in depth of what we're talking about. But we took a look at 3 stocks that are trading at their 52-week lows. And the key takeaway first and foremost is the fact that just because a stock is trading at a 52-week low doesn't necessarily make it a cheap stock. There's a number of cheap stocks that are out there and a number of them that are cheap for a reason. If they're underperforming, if they're less efficient, if they're growing less than they have in the past, they're going to underperform. Investors aren't willing to pay for those particular stocks because they're getting older. Look at the likes of Nike. Look at the likes of Starbucks, McDonald's, PepsiCo, Bristol Myers Squibb, Hershey's. There's a number of stocks that are trading at or near 52-week lows of late. And again, not all of them are necessarily cheap. They have some operational issues, especially with the likes of Starbucks. They had transactional issues. Traffic, prices went up, consumers pushed back. Nike, they're having some issues in terms of traffic as well. Consumers pushing back, but there's also a lot of other competitors, a lot of other choices out there. We've seen Lululemon come down even. The likes of Lululemon. Is athleisure wear kind of that trend slowing down a little bit? Or is there just a lot more options out there? There's Viore, which is a private company. There's 10,000 out there if you haven't checked those ones out. Those ones are geared more athleisure, but more geared towards, I think they just have men's clothing there. So based on the recent video that we did, we looked at PepsiCo, McDonald's, and Bristol Myers Squibb. If you watched that, or whether you've watched it or not, and if you haven't, make sure you go check that one out. Which company would you be most comfortable buying today at today's prices? So if you had to choose, let me know in the comment section. Would it be PepsiCo? Would it be McDonald's? Or would it be the likes of Bristol Myers Squibb? So we have 2 kind of consumer goods type companies, consumer discretionary, if you want to call it, with McDonald's, and then a healthcare company with the likes of Bristol Myers Squibb. So let me know in the comment section, which of those stocks would you rather be most comfortable owning right now at today's prices? And let's check out what the folks are saying right now. What is up, man? How is everyone? Someone's excited for the Power Hour, and I love to see it there. Scott's got a question here. Another example, I own Home Depot and Costco. Those are 2 stores that I love right there, not necessarily stocks, but does it make sense to own VDC too if some of its main holdings are HD and Costco? This is why I'm thinking of selling XLY since I'm going to buy Amazon. Yeah, so if you're looking for broad sector exposure and don't necessarily want to pick one, that's definitely a great way to go. So just look for some low cost options that focus on those particular sectors. Great, easiest way to help diversify your portfolio there. So, my rule of thumb when it comes to individual stocks is I don't want any individual stock to be more than 10% of my overall portfolio. And that's me bringing all of my portfolios together, excluding my 401k, my Roth IRA, my trading accounts, taxable accounts, bring them all together. Let's line them all up. And I want to see where is the highest weighting. What stocks do I have the most invested at in that from there, so that I know that I'm not overweight, because I look at everything together. So individual stocks, no more than 10%. That would be the first thing that I would look at when it comes to HD and Costco, and then start taking that into consideration. If you have 10% for HD, 10% for Costco, and you go look at VDC and they're a large weighting there as well, that goes into that something to consider there. But when it comes to ETFs, I don't necessarily have that rule for myself. They can go above 10%. But again, I don't have any that are above 10% outside of an S&P 500 there. Next question. What do you think of SCHD? Should I sell and buy VU? Well, I think those are two entirely different ETFs. So there's different reasons to buy each of these. And I think I've mentioned it in videos before why SCHD is one of the best complements to the likes of VOO, because VOO these days, S&P 500 ETF, low cost, is so tech heavy now. It's over 30% towards the technology sector. But when you look at the likes of SCHD is no longer tech heavy. SCHD is, I think it's 8 or 9% technology exposure from that standpoint there. So that's one reason that I think I like to own both of these. S&P 500 at the top for me, followed by SCHD within the top 5 there overall. Well, that one's a loaded question because I have no idea what's in your portfolio. I have no idea what's talk about, how much risk you're willing to take. What is your overall goals? Is it dividends? Is it growth? This is all things that I talk about within my 6-week course, is to build out yourself a strategy, build out an action plan, and then determine showing you how exactly I like to analyze and value stocks. That's the core premise of my 6-week program. If you're ever interested in that, definitely check that out. You can book a free information call there. So JC is Cashflow University, a monthly subscription. Yep. So within Cashflow University, we have a number of fantastic traders that are out there, and you can go in and follow those traders along. But there's also different sections. There's a monthly options trading section. There's a weekly options trading section. And then as you get more comfortable, you can go into what's called CFU Black Trade Alerts, where you can go see a little bit more sophisticated type option trades once you're there for about 6 months and everything. But it's a fantastic community of over 850 members within that community where you can learn all about options investing and follow along with us traders there as well. So, and you can go to join. I'll drop a link for you in the comment section down here for you to go and check that one out there. So Alex Rodriguez, wow, the baseball player there. What do you think about Pepsi? So we're gonna have to go check out that video there. So that's another stock that's trading near 52-week lows. Definitely one that you want to take a closer look at. And is it down far enough? I don't think it's down there far enough. Again, I don't have a position in it. I own shares of Coca-Cola, but that's one I'm waiting for a little bit of a deeper fall. So JC, you can check out that link I just put at the bottom of the in the comment section there if you want to go check out all the information. We have all of our trading performance that we have shown there as well. So definitely go check that one out. McDonald's is one that you'll see in the video that I actually like. It's one that I've bought more recently and one that I'm looking to add to at these levels, especially if we see that stock go a little bit lower there. Robert said, yes, real estate. This smells like a good buy on REITs. Definitely, with where rates are, with where valuations are, it all kind of adds up to where the direction's going to be. A lot of that money that's been on the sidelines is going to come in. And when it comes in, a lot of it's going to go towards that REIT sector that's been beaten down. It's just not going to move until we get a clear picture on where rates are going. Matthew, good to see you, my friend. Is it too late to get into Tesla? Well, it had a big dip. It had a massive dip there. So if after that dip, if you're still waiting for a bigger dip, that's a big one. That's where you want to take the approach of dollar cost averaging. Just add a little bit here and there. Don't wait for the exact, bottom and trying to time the market when it's on its way down, when it's down 20%, down 30%, whatever it may be. Just start adding along the way. Just do your due diligence first. Make sure you're buying at a good valuation. If it's not a great valuation, you don't need to back up the truck. Like, let's say a full position for you was about $5,000, or throw out whatever number that you want to do. We'll make your first purchase $1,000, $2,000. And then if the stock keeps dipping, buy another $1,000 or $2,000. If it dips again, finish off your overall purchase from that standpoint. That way you were averaging down. It can average up too as well from that standpoint. Austin saying no recession. All right. Brooks is the new Nike. So let's see. Now we're getting into the comment section of which stocks folks want to buy at today's prices. So we got PepsiCo, McDonald's, Pepsi, McDonald's. Ooh, we're tied so far. McDonald's, Pepsi, BMY gets their first vote. McDonald's, I feel like that geopolitical risks are temporary. McDonald's for Robert. Pepsi, this is a close one here. Bought 100 shares of WMB. Matthew's going McDonald's. McDonald's threatening to leave California. Won't you gentlemen have a Pepsi? I already have a small-ish position in BMY, just adding $50 a month. From Kevin there, BMY as a DY with 587. Sounds interesting. Pepsi out of those three. McDonald's had 10% dividend increase the past 2 years. So that's my vote. Thanks for the info. You are welcome. Pep versus Hershey's. Which one is better? So when it comes to my portfolio, I own Hershey's and I don't own PepsiCo. My kind of way into the beverage area was through Coca-Cola. The snack piece gives me concerns. It's number one, lower margins, but there's just, again, similar story to that of Nike and those other companies with how much competition's out there. Well, when it comes to food, especially this millennial type generation is more fixated on some health. They have some areas that, hey, I want to know what's the healthiest option. So there's a lot of new companies out there. You know, think of Frito-Lay's or Siete chips. I couldn't tell you the last time I bought Frito-Lay's. Number one, I don't like it. I think they're disgusting. But number two is we go towards a healthier option from that standpoint. And I know a lot of folks that tend to go that route as well. Ron, how you doing? Good to see you. JC is going to look into that there. You are very welcome, my friend. Do I invest in international stocks and ETFs? So usually, I've had some BABA in the past, got out of that. Don't own any right now. There is some sectors I'm looking at in particular, and that is over in India. So haven't really pulled the trigger on buying a particular stock there yet, but looking at some different ETFs to give me some exposure to India, because I think there's a lot of, the geopolitical risks with China, but a lot of companies at the same time are moving out of China. And they're going to find some other areas, one of those being over in India, where their economy is growing at a very rapid pace with how many, people that they have there and things like that. Is they're gaining a lot of traction in India. And this is nothing new. This is not earth-shattering for those that have followed closely, but that is somewhere that I want to get some exposure to in terms of international there. Is Nike a good buy? So that's one that's kind of in that falling knife category right now is Nike. So I got into Nike with a cash secured put, went below my particular one, my price right now. So I'm holding that, selling covered calls, generating more income. So I'm doing what's called the wheel strategy, something else that we teach within the 2-part option module. So if you're not interested ever in the 6-week program and just want to learn options, you can definitely sign up for our 2-part option module. Just reach out to me and we'll be happy to get you on the schedule there. And should my longer investment window play a role in my balance of individual stocks and ETFs? Yeah, so building out your foundation is what I kind of like to call, I refer to it within our 6-week program, is focusing on building out your foundation first. For me, the foundational piece is that S&P 500. And for those of you that are going to join me tomorrow for that free investing webinar, that market update, you're going to see my top 10 positions overall. But I'll give you a sneak peek. The top positions in S&P 500 index fund there. And that will probably not change for a long duration of my investing journey if it changes at all. We're going Pepsi here. JC's going McDonald's. Do you think NVIDIA will reach $150 a share? Is that on a time point, or do you just think ever? If it's ever, then yeah, certainly. I think the way they've been moving, they could probably be there after hours quite easily here. So Chris says, love this channel so much. It's better than what they teach at the university. Awesome. I appreciate that, Chris. And for those of you that haven't done so yet, definitely check out that like button down below. That really shows, anytime you're watching any of my videos, it shows YouTube that you guys enjoy the content. I appreciate it. And it helps push out that video to even more audiences so that we can have a growing group here at the Dividend Power Hour. Don't forget the upcoming $250 a month portfolio challenge in the Discord. It's going to be awesome. Yes, Robert is well aware of that. So we'll be adding something new for Edge Plus members, is creating a brand new portfolio, adding $250 a month to make buys there. So you can make it whatever value you want. We're just starting with low values from that standpoint and adding to it. But as an Edge Plus member, you also get to see what's in my actual portfolio, my personal portfolio, I should say, as well as Chris, who helps me at the Stock Investors Edge there. I forget how we're able to read your book. I feel like I had a link to it last year, but forgot about it. It looked great, but I can't remember. I think I read a chapter or two and loved it. Still there. So that is something that it's a PDF version. So anytime, whatever link that you had that was given to you, that would give you access to that here. Love your channel, bro. You are a legend. I appreciate that. Just like the video. Thank you, guys. Thank you, thank you, thank you. Thanks, Mark. My top holding is actually SMH, but my next biggest is SCHG, QQQ, and SCHD. So that's my foundation with diversity. So that diversification right there. I love to see ETFs at the top of any portfolio. I think that's a great way to build it. And then if you want to, not everyone wants to, but if you want to add some risk, then you could start sprinkling in some individual stocks from that standpoint. But building out that foundation is definitely going to be the key for future wealth there. Can I tune into YouTube tomorrow for the free webinar? So it's going to be focused on, or it's going to be produced on YouTube. So the link that you get when you sign up using the link down in the description below, once you sign up, you will get sent a link of where you can find the free investing webinar tomorrow. It's going to be produced through YouTube, but it will not be made to the public from that standpoint. So it will be an unlisted video just for those that are signed up. So if you are interested, and think maybe you can come, because I know a lot of folks said, hey, I'm in different time zones. I'm over in Europe. We have people in Australia that signed up. You will be able to have the opportunity to sign up for the VIP one to get a complete recording of that. That'll stay with you forever, and you will have access to that, as well as some videos and my book there as well. So just in case you are just joining us and you're wondering, well, what is this free webinar stuff you're talking about here, Mark? Here it is one more time. We have a free market update, free webinar tomorrow. If you sign up using the link down in the description below, we're going to do a first half recap of what happened in the market. We're going to focus on the second half. What are some concerns? What are some reasons to be optimistic? S&P 500 targets. Where do I think the market's going to go? My top 10 holdings. It's going to be a fantastic time. We're definitely going to dive a lot more deeper than we do on our regular Dividend Power Hour, because this is just week to week type of information that we do on the Dividend Power Hour here. So if you guys are interested, definitely save your seat. There's a link down below. It's completely free to join from that standpoint. So hope to see all of you there. So now let's transition over to rate cuts. So we heard from Jerome Powell today, the Fed chair there, and he testified in front of Congress talking about the concerns of keeping interest rates too high. Because if we keep interest rates too high, and we keep them too high for too long, that could be detrimental to both an economy as well as to employment. So we could see increased job loss. So we've already seen upticks in that. We've seen the number of job openings start to come down. We've seen cracks in the economy. GDP is slowing down and things like that. So, that jobs report we got last week wasn't all that great. So, and we saw the markets absolutely didn't do much when it was released from that standpoint there. So pay attention to the revisions. The government keeps putting out numbers, and the numbers look, solid on paper at first, but then the following month, they will do revisions to, once they have more data, to what the most recent report is. And if you go back in time, most of those revisions are negative revisions from that standpoint. So it's almost like they're over-promising and then finally under-delivering from that standpoint. So definitely pay attention to the revisions. A lot of investors don't pay attention, but the best investors pay attention to those revisions there. So higher rates can slow economic growth, which they're trying to do right now to bring down the CPI, to bring down inflation, the cost of those goods. But at the same time, if you slow economic growth and keep rates too high, which slows it too much, that could result in job loss. So they're trying to walk that fine line again of not keeping rates too high, not moving too early, because if they move too early, that could just send inflation flying high again. So it's not an easy job by any means. I know everyone's an expert on YouTube or on CNBC, Yahoo Finance, wherever it may be. Hindsight's always 2020. It is a difficult job because you move too soon, boom, inflation can keep going up. You move too late, we could have a lot of people without a job, not a lot of job openings, and us falling into a recession. Very fine line that they have to watch there. So let's go over and take a look at the Fed Watch tool. So let's add this iPad back to our stage here. And let's take a look here. So here is the next meeting, which is going to take place on July 31st. As expected, there's not to be expected any rate cuts here. So you could see 96% of folks still believe, or there's a 96% probability that rates are going to remain unchanged. However, When we move on to the September one, that's when it goes, everything changes from that standpoint. There is now a 70% chance, as you can see here on our screen, 70% chance of a potential rate cut. Right now we're at 525. 70% chance says we're going to go down to 5 flat there. So 5%, a 25 basis point rate cut from that standpoint. Again, I don't think that's going to be anything that's going to change anything entirely from that standpoint, but it begins the process. And I believe that once they decide now is the time to move, I think we're going to get another one shortly after that. I don't think we're going to go through a period where we do a rate cut and we wait 6 months. I believe that once they decide to go, they're going to go again shortly after that from that standpoint. But let's take a look at where this probability has moved in a short period of time. So if you look down there at the bottom, you can see that just 1 month ago, back on June 7th, if we look at that 5, it was pretty much 50-50 based on were we getting a rate cut or not. It was leaning more towards no. But now, as you can see up here, we have a 70% chance at a rate cut in the September meeting, which is expected to be a live meeting. So if we go forward there to the November timeframe here, you could see that 51% still believe we'll be at that 5%. And then if we go up to the December meeting, which is when I believe the next rate cut means or will happen, we could see that we are at 47.6% to be at 4 3/4. So at that point, that would be 50 basis points in rate cuts to end 2024 here, which is still kind of where I believe that we will kind of land from that standpoint. So here's a look at the probabilities now. So let me zoom in on that. So right now we're at 5 1/4 again. September meeting, we believe will be down to 5 flat. That's 70%. And then by either this particular meeting here, which is December, close to 50%, we could be down at 4 3/4. By this time next year, a year from now, they are suggesting, based on the probabilities, the highest, and again, it's less than 30%, so take it for a grain of salt, that we will be right in this area, which means we will have seen about 125 basis points of cuts by that time. So July 2025 going out, that's kind of where the probabilities sit at this very moment. But as we saw, they're always just a moving target as we get more data. And it always goes back to that, I want to say it was that April timeframe when we talked about it here on this very show when everyone said, nope, no rate cuts. There's going to be 0 rate cuts the rest of the year from that standpoint. And what my comment was is don't let one report change everything out from that standpoint. And that one report was hot. That one report was terrible from that standpoint there. However, we have seen that that things can change, and they can change rather quickly from that standpoint. So definitely things to consider. All right, so let's keep rolling here on our Dividend Power Hour. Thank you guys for hanging out with me this afternoon, this evening, wherever you're tuning in from. Could be the morning for some of you if you're over in the Australia time frame. So here were some key comments that came out of that testimony, that Congress testimony where Jerome Powell was at. He mentioned reducing policy restraint too late, this is what we just mentioned, or too little could unduly weaken economic activity and employment. So they're kind of walking, again, that fine line of looking at economic data and keeping an eye on where the job market is. And the job market has been resilient thus far, even in the face of high inflation and high rates. The most recent inflation readings, however, have shown some modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably towards 2%. So again, 2% is their goal that they're trying to get things down. Do I think it needs to get to 2% before they cut? No, not entirely. I just think they want to see progress. Then they will have more confidence that, hey, we're headed in the right direction. Now we can start easing off a little bit, 25 basis points, 25 basis points, no big giant cuts, 50 basis point slides or anything like that. They're going to be slow, methodical from that standpoint. But once they start, I don't think they're going to stop and take like a 6-month break by any means. And then the third main one I took out of it was job creation is narrowing in the economy. So the Fed too, based on the data that they see, which they see a lot of data, is they are seeing cracks in the economy. They are seeing cracks in the job market to where it was once this very strong thing. It's nothing to be concerned about at this very moment, I don't believe, but there are starting to see some cracks. So they're taking note of that overall. So now let's take a look at the June CPI report. So this is due out this week. This is going to be our latest reading that we've got to see. What progress are we making? What progress is the Fed making on impacting CPI? So, there's two big reports that come out around inflation, and they have different weightings, and shelter costs have really weighed on that CPI report. One thing I like to focus on more than just the headline report is core CPI. And what core CPI does is it takes out energy prices and food prices. Those are very volatile. Out here in California, sometimes it's $5 a gallon for gas, and sometimes it's $4 a gallon for gas. It's crazy, I know. But so here's a look at the expectations. So CPI expectations month over month are expected to be pretty much muted, plus 0.1% from the last month. Year over year, we're right around 3.1%. However, when we look at core CPI, month over month expected to grow 0.2%, and year over year is closer to 3.4%. So we are still high, but we're off the 9% thresholds. We're off the 5%. We're off the 4% where we were a few months ago. So we are trending in the right direction. You got to take it, take it with a grain of salt too, because what are our comparables that the fact that we're still growing at rates that fast when last year is when we were talking about being up 5 and 6%. And the year before that, we were up 9% or whatever it may be. So these are very high comparables that when you extend things and look at not over 12 months, but over 24, 36 months, prices have gone astronomical. And you've probably seen all the different things that are out there on people that have seen their receipts from a year ago compared to the same batch of goods this year. It's pretty wild. And it's not 3% higher. It is hundreds, it feels like, of dollars a lot higher. So let me jump over here to the comments. I know a lot of you have been dropping in here, so let me make sure I'm not missing anything in particular there. We touched on the YouTube for tomorrow. NEEWMB just reserved my seat. Thanks again, Mark. In the words of my boy Kramer, booyah. Need to get energy prices under control if you want to get inflation under control. Like and subscribe there from the J. Appreciate that. Packing Bones said, you consider Kramer your boy. Inverse Kramer, right? Is it good to own VOO, QQQ, and SCHG at the same time? Just understand your overlap. So you can type in ETF overlap, and there's actually a site out there that'll show you how much overlap you have. So just know that going in, I don't know what the rest of your positions are, but you're going to be very heavy technology. So if you get another year that comes in like 2022, technology got smoked. So that's where the key is, to be very diversified. Doesn't mean everyone needs to have all 11 sectors need equal weighting. We just want to be well diversified. You could be overweights depending on where we're at in the economic cycle. And I show you that there's a whole slides that we go through within the 6-week program that shows how the economy changes through different cycles and which sectors work during. There's most of the students that come through my program, they print that out, and I have mine over here on the wall right here that shows those different cycles that we go through in the economy and which sectors we need to start thinking about to be invested in there. Eagles fans, I'm interested in learning options. How can I sign up? Just send me an email, mark@russinfinancial.com, and we can connect from that standpoint, set up a call there, and give you all the information that's needed there for that 2-part option one. What else we got here? Robert said, Pepsi, McDonald's, and BMY are covered in last Saturday's video. The video was awesome, as always, very informative. Thank you, Robert. Inflation is still way too high. Nope, not getting into politics. What else we got here? What if SCHD people switch to FEPI? I'm not sure what FEPI is, so I'm going to look it up right now on the side. FEPI is the RECESSION Innovation Equity Premium. So we have an expense ratio of 0.65, which I don't like to see at all from that standpoint there. So high expense fees are something that is a major turnoff when it comes to investing from that standpoint. What are your thoughts on investing your dividends from a stock you're heavily invested into, a separate ETF to diversify? What are your thoughts on investing your dividends from a stock you're heavily invested into a separate ETF to diversify? So there's 2 different ways to reinvest your dividends. You can just drip them, turn on the drip. The brokerage will automatically reinvest into the stock to where the dividend came from, or you can pull them together. I happen to pull a lot of mine together from that standpoint there. So, and I look, but that's a little bit more hands-on for those that, if you're out working, you can't be in front of a computer all the time, just turn on the drip. It's kind of cruise control from that standpoint there. Definitely a good way to go. There's no right or wrong answer in particular. It's really just how hands-on or hands-off that you want to be. All righty. So let's keep jumping over here now and back into the slides. So June CPI report coming out on Thursday. Make sure you stay tuned for that. There could be some fireworks if we do get a surprise one way or the other in particular. So what are we going to look at next? How about some housing affordability? And I threw this slide in late today before we looked or went live here, because I saw this stuff come across and it was very shocking to me. So what we're going to look at is we looked at some more housing affordability last week. And these are California prices. So this data here is really focused on California. That's, again, where I live here. And as most of you know, California, a very expensive state. Housing's expensive. Taxes are extremely high. Gas prices, so on and so forth. So California home prices rose 1.6% month over month. That was from the May report. California prices have risen 10% year over year in terms of housing. But check this out. The median home price, median, not average, the median home price here in the state of California is nearly $900,000. That was a shocking figure to me. I mean, one part of me is shocked, but the other part is not shocked. What this means for a home buyer, think of all these first-time home buyers that are out here. They would need household income. If you're a single income family, you would need a salary of over $200,000 just to afford a median home in the state of California. So, and then the rule of thumb that's out there, people always ask me, how much house should I buy? And again, I don't do a ton of finance related stuff. My stuff is more fixated on investing and helping people get portfolios set up, how to value stocks and generate wealth for long periods of time. But I do get questions from time to time around budgeting and around finance and things like that. So the rule of thumb that is out there is do not buy a home where the monthly mortgage is more than 25% of your take-home pay from that standpoint. Now, if you go and ask Dave Ramsey, he says, well, you need to buy 100% cash. Not realistic, Dave. I'm sorry. If you're watching this, Dave, if you're one of the well over 100 people that are watching this right now, most folks aren't going out there and buying homes for 100% cash from that standpoint. If you're able to, that is awesome. If you have that ability and that much cash, that is awesome from that standpoint. But the most of us that are here learning about investing and looking to build wealth, we don't have $900,000 sitting in the bank account right there just to be able to go use for free to buy cash. So not going to be an option here in the state of California for a lot of folks there. So that is housing. So now let's take a look at software. So software got hit hard back in May. You may recall we had some earnings reports came out and everyone, it seemed like, was getting rid of their software stocks. Look at the returns here. And again, this was in a month during when the S&P 500 was up over 5.5%. So CRM down 16%. That's Salesforce. Intuit was down 8%. Adobe was down 8%. ServiceNow was down 10% just in the month of May from that standpoint. And then now look at how they have returned. We've had a nice little bounce back in software stocks since the start of June. So since June 1st, Adobe is up 21%. That's a stock I own. Love to see that. PANW up 11%. I don't own any of that. IGV, so this is a software ETF focus, just to show you how much ETF as a whole without looking just at a few, but software stocks as a whole. IGV up 10% since the start of June. ServiceNow is up 9%, and Intuit is up 6% since the start of June there. So they have rebounded. We have seen a bottoming in software stocks. Well, now in the comments section down below, for those of you that own any software stocks or software ETFs, which one are you most excited about moving forward? So for me, I like Adobe. I'm looking closely at PANW because that's kind of software. It gives you that cybersecurity, very similar competitors with CrowdStrike, which is a stock that I've owned over the years that has done fantastic from that standpoint there. So Dave never said go buy a home in cash. I wouldn't. I don't know about that one, buddy. Jim C. Dave does not say pay cash for your home. He does. He doesn't like debt at all. I mean, you're talking to the debt guy. You think he wants you to go out and take debt? Now, he has talked about it before, but he always says, hey, take the cash and buy home. That's what you want to buy a home for again. But that's neither here nor there of the conversation. We were talking more about home affordability there but people do love to defend Dave there. So I am well aware of the Dave Ramsey fan base there. All right. So in terms of software stock, which ones are you most high on? Is it any of these listed? Is it other ones? Is it something like a CrowdStrike, which is more of a cybersecurity, but still could be referred to as a software stock? Is it Adobe? Is it Salesforce, which is that's kind of been a drag a little bit more on the Dow Jones Industrial from that standpoint, which if you recall, and if you're not aware, the Dow Jones is a price weighted index. So the higher the stock price, the higher the weighting within the Dow Jones there. So I want to start DCA into CrowdStrike. So CrowdStrike has been on an amazing run from that standpoint there. Always look at valuation. Always look at valuation and DCA. I never approach a stock to where I'm backing up the truck from that particular standpoint there. So Jim Betts is in the house. He's got some CrowdStrike in his taxable account. Awesome. Big future for cybersecurity. I believe that cybersecurity, and if any of you joined us for our beginning of the year, one of my trends for the year was continued around AI, but the sector I was most high on was around cybersecurity. So for those of you that joined, you probably remember that one when we did talk about that there. So Jim C works for Dave. I don't know. 15-year mortgage. So if you don't have cash, Jim C is saying 15-year mortgage, or he's saying Dave is saying 15-year mortgage. So not sure from that standpoint there. So sign for 15, paid off in 10. Anytime you can pay it off early. If you have the additional cash, absolutely. Pay it off early. You could save a lot in interest. Now, if you have a very low, if you're talking about a 2% interest rate, then you maybe don't want to pay it off too fast from that standpoint. And that is a very heated topic for some folks, depending on who you ask. I'm not a big proponent because I believe that I can beat 2.5% from that standpoint. But if you have you have a new one where you're at a 7%, you're at a 5%, it's always good to get it off. And I understand the approach when folks say, hey, I just want to be done with having that debt. And that is a great thing to do. It's definitely going to help from that standpoint. And if it relieves pressure, absolutely go for it. If you can do it, you definitely go for it, because there's nothing better than having your mortgage paid off. It relieves a ton of pressure. I definitely know all about that there. So Jim Betts says cybersecurity became a hot topic when I think it was UNH got hit with the hack. Yeah, UNH got hit like a double whammy. There was two different things. They got hit with the cyber attack, and then I forget the other report, Jim, you probably remember it, that we were talking about when UNH got hit back in the day. What was that, 3-4 months ago? Stock fell 15-20%, whatever it was there. Investors Edge tuning in here. Going to go with Intuit in terms of their software. What do you think about Broadcom and Chipotle recent stock splits? Good time to get in those. So again, remember, when it comes to stock splits, there is absolutely no change in the market value. Market cap does not change whatsoever. If you have a company that's worth $100, whatever their price per share is, they go through a split, they're still overall market cap is still $100. Okay. So it's just more shares, lower stock price, or they could do a reverse where it brings a higher stock price, less shares. But most companies do stock splits from that standpoint there. Frank V is going to do some Broadcom, or Broadcom will split this Friday. So that's the upcoming Broadcom one. I forget when the Chipotle did. What other ones have we had recently? We had Walmart did a split. We had Nvidia also do a split. So a number of companies. I guess it's the cool thing to do again when it comes to stocks here. So now let's get to Tesla. So Tesla has had a 10-day winning streak, and that continues. As of today, they are continuing that streak where they've seen 10 straight days of green there. So it's definitely went through a big dip. Let's see if I can pull up the Tesla chart there. So let me type in Tesla on the iPad here. We'll jump over to that right now. So here we go. Look at this run that we've seen in the past month when it comes to Tesla. Just up, and away there, up 48% in the last month alone when it comes to Tesla. But if we look year to date, still only up 5%. So up 48% in the past month just tells you how far this company fell and what they're making up for it from that standpoint there. But it looks like a lot of folks over here, at least the last two, don't like the run there. Sell the rip. Tesla's valuation blind spot for investors. So who knows from there? I don't own any Tesla. I do a lot of option plays with it. We do it a lot at Cashflow University, that you can see all of our top Tesla plays there. So I don't own the stocks outright from that standpoint, but I do definitely do options with it. Sunnyman is saying Tesla is overvalued right now. Jeffrey's got a comment. Jeffrey, cybersecurity has a long runway. I agree. I believe this is something that's in those early stages. If you start staggering with AI and cybersecurity kind of at the same time, it's definitely, two areas to be, if there's two areas to be a little bit more overexposed to, I don't think you could definitely go wrong with either of those there, especially having both of them there. So Jim says tailwinds for cybersecurity as a business and corporations are becoming more proactive than reactive to cyber threats. Question, Hogue, why do stock splits? Well, when you get back in the day before fractional shares came about, and there's still actually some brokerages, believe it or not, that don't do fractional shares. So let's say you had a stock like Nvidia that's up at $1,700 or whatever, or Broadcom, I should say. What is Broadcom at these days? $1,733. Well, to buy one whole share, you would need to shell out $1,700 for just one share. Well, this day and age in fractional shares, if you wanted to invest $200 in Broadcom, you can go buy a tenth of a share, $173, a tenth of a share of Broadcom. It's a fractional share from that standpoint. So it makes it a little bit more intriguing to investors from that standpoint. It opens up a lot more optionality in the options investing, no pun intended there, because again, when it comes to options, one option contract equates to 100 shares. So 100 shares of a $1,700 stock, that's a tough one there. But 100 shares of a $100 stock, a little bit more meaningful and available to a lot of option traders and a lot more folks from that standpoint there. Apple did one less than a decade ago. And that was partly due in part that they had the largest stock price within the Dow Jones Industrial, which is a price-weighted index. So again, it wasn't really, it was whatever Apple did, it moved the whole Dow with it. It had so much weight behind it there. So they cut their price down. I think they did a 5-to-1 back in the day there. And now United Health is the largest stock price within the Dow Jones Industrial. So those are some of the reasons behind why companies, it doesn't change any market caps on the day of the split. Stock price comes down, the number of shares go up there. So what else we got? Stock split only to make it easier for people to get into stocks. Yeah, as we just mentioned there, that was one of the reasons there. Watching from Canada, big shout out. Awesome. Jim C, how do you recommend exiting a stock like Nvidia? I am way up, but don't want to sell way too early. Well, Jim, it's really going to come down to, first off, my first question would be, well, how many shares do you have? If you have over 100 shares and you already want to trim your position a little bit, you could sell what's called a covered call. You want to sell already, so that's a way to do it, and you're going to generate income by doing that trade at the same exact time. I do this all the time with positions I want to trim. There's two options. You could just sell outright, or why not sell a covered call at the money from that standpoint. So there's other ways to generate income and get the job done of trimming down your position that you already wanted to do. Daniel said stock splits nowadays are for options. That's another big reason right there. More than not fractional shares. Sorry for dumb questions, just learning. That's the whole point here of the Dividend Power Hour, and all of us here is we all want to learn. We all have one goal in common, regardless of whether the Dave Ramsey folks agree or not. But we all have one thing in common, is we're all trying to gain wealth and find ways to where we can set up and build that foundational wealth. That's my whole goal with my business when it comes to coaching folks. When I do one-on-one coaching, I'm looking to help them build wealth, but ideally, I'm helping them to set up a plan so that they can build what I like to call generational wealth. Leave a lasting legacy for whether it be family members, kids, friends, whatever it may be, or whoever it may be for. That is my goal when it comes to everything that I do financially related from that standpoint there. So we are pretty much up at our hour. And again, just one more time in terms of our free webinar tomorrow. Let's go through that one more time so that you can see it. If you are just joining us tomorrow, we have our free, I know everyone loves to hear that price point right there, market update webinar, going through a recap of the first half of 2024, looking ahead to the next half, the back half of 2024 there. What are my top positions? What sectors am I looking to add to right now? What is my game plan for this current quarter right here? A number of things that we'll be touching on. It's going to be a fun time. I know I'll see a lot of you, a lot of familiar faces there, or familiar names, I should say, since all of your faces aren't on your YouTube channel handle there. But I will see a lot of familiar names there, and it will be a good time of getting together there. You can check out the link, save your seat there to get the free video link that'll be sent to you. With that being said, thank you guys so much for joining me for this Dividend Power Hour. We will see you at the regular time next Wednesday for our regularly scheduled Dividend Power Hour at 4 p.m. Pacific time, 7 p.m. Eastern time. Again, it's been a joy coming into your house, your iPad, your iPhone, wherever you may be watching. Thanks as always. Mark Rusin is tuning out here. Take care, folks.